Hello and welcome back, folks, as we begin a new week in the financial markets. And we are back with our another round of updates on the global financial markets with Almus Market Mornings. And this is your host, Shikhar Garg. And I hope you guys are well rested because the bumpy ride of financial markets looks to be continuing, though with some corrections this time, as we see currencies are showing small but some meaningful corrections in the aftermarket hours from Friday and early morning hours of Monday. So, JK, there's some small corrections that we are seeing, but the inflation numbers are persistent and the doubts on the central bank actions are also continuing. What do you have in store for us?
Yeah, good morning, and we are on to another week. Important week because we have a ECB meeting this week, and that's the most look forward to event because European Central Bank is the one who is lagged behind in policy action, despite facing multi-decade high inflation. So on the Friday's price action, risk sentiment rallied with better than expected US retail sales print, and also Citigroup shares lifting the equities, like all of them being exacerbated by the positioning also. I mean, the market was has been running short positions in stocks. People have underowned stocks, so some of these factors have actually played out. Retail sales rebounded strongly as the consumer spent more on gasoline and other goods. But the important point to note is that the inflation adjusted retail sales would have been much lower. So they have spent the same amount, but probably they bought the same amount of goods. So because the number is not adjusted for inflation, so that way it was not such a great number. The other number that came out, the manufacturing production slumped for a second straight month in June, and again implying softening demand as Federal Reserve has been hiking the interest. But what would have pleased the policymakers and the markets was the tempered inflation expectations in July, alongside a drop in gasoline prices in the past 2 months. Inflation is seen rising at 2.8% over the 5-year horizon, lowest in a year, and down from 3.1 in June. And the 1 year look, moderated to 5.2 from 5.3 earlier. Fed does give a lot of importance to these numbers, and market is now leaning more towards a 0.75 rate increase rather than the 1% that was being factored in immediately after the CPI numbers came. Michigan report showed consumer sentiment also remaining at the lows, while moderating inflation, as I said, was a bullish factor for the markets. In fact, looking at various data, some of the analysts are seeing the recession setting in middle of next year. Bank of America, in fact, is saying that economy is already in recession by some parameters, and they started to discount a rate cut in the second half of 23. I think that is one extreme view that we have seen. Importantly, there were two comments. Bostic said that everything was on the table as far as the rate hike on July 27th is concerned. Bullard, who had earlier said that 1% may be less probable and 0.75 may be par for the course. At the same time, on Friday, he said that the terminal rate could be as high as 4%. So, but right now, market is looking at the slowing economy and possibly slowing inflation expectations. That was the reason why both the Dow Jones and S&P 500 rallied strongly along with the Nasdaq, and that has also helped the Asian markets higher today. There was nothing much, and the yields were very, very subdued on Friday because even the tendency to go down has been matched with the high number of issuances from the treasury. On the dollar, of course, euro having found good support below parity has given rise to some short covering ahead of ECB meeting. And the ECB meeting itself is still not so much of bullishness or hawkishness being priced into it. I don't think ECB will surprise the markets because they're still looking at how to deal with the peripheral countries' bond prices. And although they say that tool is being prepared, no details are available and not very clear whether they will publish the tool in this meeting. In any case, because we are at such crucial levels, like one on the euro, 140 on the yen, and 120 below on the GBP, all these things are leading the medium-term players to size down their short positions on these currencies against the dollar, even as the Fed moves closer to possibly reconsidering how much a rate increase should happen if the economy should slow down in the coming days. So that's about it. But this week also we have, apart from ECB meeting, we have UK inflation on Wednesday to be published. And also we have lots of issuances from US on the bonds. So we have to see how the yields move in response to that. I expect dollar index to correct some more towards 107 or slightly below that until the ECB meeting is over. And then, of course, we will start to price in what Fed will do on 27th this month. On the dollar rupee, again, for the first time ever, we did not make much of an up move after opening with a gap, and it moved in a very narrow range. Yes, there was some selling during the day. Some murmur of bit of inflows were heard, but overall picture is still demand being very high. Oil price, though it has it stalled at 100, come down, it stalled at 100, and demand side is quite high still. And unless we have large flows, it's unlikely that this picture will change. But further move down in the dollar index can help the rupee to recover towards 79.50 or maybe slightly lower towards 79.30. Also important to note that RBI reserves fell by as much as 8 billion in the latest data published by them. And much of it was, of course, led by the fall in value of foreign currency assets. But still, RBI has been selling more, has continued to sell in the spot market as well as in the forward market. And that has reduced their forward book as well as the near-term reserve holdings. It's a big come down from 643 to 580, but nothing alarming because it's still well above the benchmark of around 10 to 12% of GDP that is being maintained by most of the central banks. So rupee, I think they will continue to moderate the fall in the rupee if it were to cross 80. I think above 80 is going to be some sort of a psychological barrier for people to buy, unless there is a strong trigger. If suppose parity on the euro breaks and sustains below 19.5 or 19, then that is the case for dollar rupee also to break 80. Till then, I think most of this week we should be in a slightly narrow range, slightly lower range rather, between 79.30 best on the downside and 80.10 best on the upside. Thank you.
Okay, JK, that was quite refreshing and interesting. I mean, for the first time after quite a long time, I've heard some bit of a commentary on the correction for USD INR, which has been on the otherwise constant uptrend. I think we saw 30 days of a constant move on the higher side after opening. So quite a good change to hear in the USD INR commentary. And folks, there's also an interesting update on the ECB front. We are having the ECB meeting, as JK mentioned, and a lot can be expected out of that meeting, and the move for euro as a currency can be anticipated from that particular meeting. So let's see how we are seeing the currency moves happening in the financial markets. Meanwhile, a lot of equity players can enjoy some bit of bullish action after quite a while. So let's just see how things move ahead. Till then, we take a break for today and come back again tomorrow. Thank you so much for joining.